Is this enough, Michael McKee, to say people underestimated the strength, underestimated the resilience, and that disinflation isn't happening nearly as much as people expected a month ago?
Well, it's not happening as fast as people expected, and I think that was the big takeaway from the numbers that we've gotten this week. People thought, given what we saw in November and December, that prices would come down very quickly. They're coming down, but not very quickly. Goods prices, remember the story was that goods prices were going away and services were the issue. 1.2% rise in goods prices in the PPI for final demand during the month of January, and services only up 0.4%. So the opposite of what we were looking for. And I got to mention the PPI for trade services, which is basically, they calculated from the margins of retailers and wholesalers, up only 0.2% after 0.8 the prior month. So what we're seeing is a compression in margins, and there's a story on the Bloomberg today about how in the past that's usually led to layoffs, which is not happening this time.
We got to get to Michelle Meyer with her wonderful view on the consumer. But, Mike, I've got to ask you about the Fed speak today. Professor Rogoff sat in your chair 2 days ago and began to model out 6% yield structure. Bullard, who speaks today, shocked us with a 7% what if out a ways. Are we shifting up now? Are we going from a low 5-ish up to a higher view or guesstimate out?
Well, right now, the consensus seems to be they're going to get to 5.5. Now, that was yesterday before today's numbers come in strong, although that Philly Fed is an outlier. The issue is we still have a lot of data between now and March 22nd. So a lot of opportunities for people in the markets to either price higher or change their mind.